In today's class, we'll cover reading 6 discounted cash flow applications. Okay, just at a high level, what we are doing here is building on the concepts that we did in reading 5, which was time value of money. So effectively here we are applying the time value of money concept to, we are basically doing various practical applications of time value of money. Specifically, we'll talk about net present value, internal rate of return, and then we will get into portfolio return measurement. The idea here is that either if you invest in, if you create a portfolio of your own, or if you are managing somebody else's portfolio, on a periodic basis you need to report performance. So if you are the portfolio manager, every quarter or even every month, you need to say what sort of a return you've given your client. Then the question becomes, what calculations are you using to come up with that return? And what we'll notice is there are different possible ways of coming up with returns, and we will look at 2 of the most important ones: money weighted return and time weighted return. And you will see that the answers are slightly different based on what you do. And then finally, we will talk about several different kinds of money market yields. Very briefly, a money market is the market for short-term debt instruments, such as T-bills and so on. So there are some unusual conventions in the money market which we need to understand by the end of this lecture. Okay, first, very briefly, what is NPV and what is NPV rule? I'd be concerned if you've never heard of this before, and I can guarantee you that if you walk into the exam room and you can't solve an NPV problem, you will not pass. So one of the most basic concepts in finance that you might as well master. And even though you should know this right now, but if you don't, I'll just give you a very brief overview. So net present value is simply, as the term implies, the net present value of a given cash flow. And we are going to, I'll just do a very simplistic example. In the last class, we talked about time value of money. And if I just give you a very simple idea, where let's say you invest 100 million in a project. Actually, let me just do it based on a timeline. So this is time 0, time 1, time 2, and let's say time 3 is the end of a project. Let's say you invest 100 in a project, and then over 3 years you make 50, and then let's say you make 60 and 70, and then the project closes. So the minus means that you spent the money out, plus means that you got the money. So what is the NPV of this project? The NPV is simply the present value of all these 4 cash flows. What's the present value of minus 100? That is minus 100. What's the present value of 50? Yeah, so to know the present value, you need to know what interest rate you are using. So let's assume the interest rate is 10%. So what's the present value of 50? 50 upon 1.1. The present value of 60 is 60 upon 1.1 squared, and the present value of this is 70 divided by 1.1 cubed. Why is this called net present value? Because we are netting out the initial investment. So the net present value is minus 100 plus 50 over 1.1 plus 60 over 1.1 squared plus 70 over 1.1 cubed. In the last class, we talked about just the present value of future cash flows. That's why we use the term present value. Here we add net because we are netting out the initial investment. Okay, so that's a quick definition of NPV. Now, what's the NPV rule? The NPV rule is that you go for a project if the net present value is greater than 0. Okay, a net present value of greater than 0 means that you are adding value. Why are you adding value? Because a net present value of greater than 0 simply means that the present value of these future cash flows that have been put in this rectangle. So NPV 0 means the present value of the future cash flows is more than the investment. So if the present value is more than the investment, that means this is a good investment, you are adding value. How much value are you adding? two ways of looking at it. The value that you are adding is how much is this rectangle, or the present value of that rectangle, how much more is it relative to the investment. Okay, that incremental amount is the NPV, and that is the value that you are adding. So NPV rule is go for a project if NPV is greater than 0. Now when we talk about projects, either you can what if you have two projects A and B which are mutually exclusive, which means you either do A or you do B, it does not make sense to do both. Then how do you choose? You choose the project where NPV is higher. Okay, so those 2 points summarize the NPV rule. If you just need to make a yes-no decision on a project, you make that yes-no decision based on whether the NPV is positive or not. If NPV is positive, go for it. If NPV is negative, don't do it. If NPV is 0, which is unlikely, but then that essentially says that by doing that project, you are making your company bigger, but you are not adding value, you are not creating wealth for shareholders. So if there is some strategic reason for doing it, go for it, but recognize that no additional value is being created. You are just becoming bigger, but maybe not stronger. Okay, so anyway, so that's where NPV is 0. If you have two mutually exclusive projects, then what's the NPV rule? Go for the project where the NPV is higher. Okay, so that is a summary of NPV and NPV rule. How many people were quite comfortable with this coming into this lecture? Most people? Okay, that's good. Alright, now if you knew that well, let's see you do this problem. So straight example 1 from the curriculum. You need to combine the NPV concept with some material that we learned in the last class. What is this a annuity, perpetuity, or something else? This is a perpetuity. What's the present value of a perpetuity? It is the cash flow, or let's say whatever the amount is, divided by the rate. So if for this particular perpetuity the cash flow is, let's say, 150,000, divided by the rate is 10%. So effectively this becomes 1,500,000 is the present value of the perpetuity. So the NPV is minus 1 million plus 1.5 million. So what's the NPV? So NPV is 500,000. Okay, so that is the NPV. So this will benefit shareholders because we have positive value. Okay, estimate whether your answer to part 1 changes if the cost of capital is 15%. Then what happens? Yeah, then the NPV is 0. Then we have a situation where, okay, the company just becomes bigger because you are doing one more project, but you are not adding value. Okay, so next we will talk about the internal rate of return and the IRR rule. The IRR is used very often in industry because it gives you a sense for what sort of a return you are getting on a project. And just to contrast this with NPV, in the last project you had an NPV of 500,000. Is that good or bad? Obviously it is good in the sense that it's positive, but how good is it? That just by looking at 500,000 you can't tell, because on that particular project it was not bad. If you can generate an NPV of 500,000 with a 1 million investment, that's pretty good. But what if your investment was a $10 billion investment, billion B? So on a $10 billion investment, if you make a NPV of $500,000, in terms of a return, it's not very high. So what IRR does is it gives you a sense for the return. IRR is not a perfect measure. There are some issues that we will see later, but it is very useful and hence commonly used because it gives you a sense for a return. Now, before I get into some complicated sounding definitions, I want to make sure everybody gets an intuition. I'm sure everybody has heard the book explanation of NPV, which is it's the rate at which NPV becomes 0. But I want to just make sure that you develop a basic intuition. If you invest in a project where you put in, let's say, 100 at time 0, and then one period later you have 120 coming back to you, what's your return? 20%. Your return is 20%. That means your IRR is 20%. So IRR is simply a measure of your return. If you have another project where you invest 100, after 1 year you get 20, and then after 2 years you get 120. What's the IRR? This is at the end of year 1, this is at the end of year 2. Okay, let me put it another way. You put 100 million into your investment account. 1 year later you get 20. 2 years later you again get 20, plus you get your 100 back. What return did you get? 20. Right? This should be absolutely basic, right? If you put in 100, 1 year later you get back 20 plus the 100 principal. What's your return? 20. If you get 20 at the end of year 1, 20 at the end of year 2, plus your principal back, what's your return? 20%. So per annum, whenever you state a rate, unless, as in the default is per annum. Okay, so if I say what's the return, and you don't qualify that this is a quarterly return or a monthly return, then the assumption is it's annual. So now if anybody gets this wrong, I'll kick them out. This is 100, and then at end of year 1 you get 20, end of year 2 you get 20, end of year 3 you get 120. What's your return? 20%. Okay. So this was easy, but it gives you an intuition for what IRR is. IRR is simply you look at your cash flows and say what's the return I'm getting. What if the numbers are slightly harder? So if you invest 100 and you get 70 and then 10 and then 90, okay, what's your IRR? Now it's harder. You can't just, unless you're a genius, you can't just look at this and say what my return is. You can sort of estimate that over 3 years I'm making 170, so 70% over 3 years, maybe over 1 year approximately whatever 20% or so roughly. Okay, but unlike the previous examples, you can't give a exact number. What the IRR calculation allows you to do is come up with that effective internal return that you are generating through this cash flow. There are two ways to do this. One is through a formula, which just for your intuition you should understand, but on the exam you will use your calculator to solve this problem. Okay, and we are going to get into that shortly. Okay, so the formula is that the IRR is that rate of return which will make the present value of these future cash flows equal to your initial investment. So what's the initial investment? 100. So what's the NPV of that? It's 100 because that's at time 0. So now you have to figure out that IRR, or we should say that return which makes the present value of these cash flows equal to 100. That return is your IRR. So effectively then, let's say that return is X. So you have, what's the present value of 70? It would be 70 over 1 plus X plus 10 over 1 plus X squared plus 90 over 1 plus X cube. Now this is one equation, one unknown. Can we solve for X? Yeah, mathematically we can do it. Whether we actually want to sit and solve this cubic equation, we probably don't want to do that. But we know that you can plug this into a computer and solve it. So your calculator is effectively your computer. If you can give it the cash flow and know how to use your calculator, it will tell you the IRR. Okay, I'm not going to waste time solving this, but we are going to use your calculator now. And we are now going to use the cash flow buttons. So let me just, so the cash flow, at least in your regular BA2 plus, this is the second row. And hopefully you've seen this in the calculator tutorial, but just as a quick recap, when effectively what we are going to do is plug in these cash flows, these 4 cash flows, and then compute the IRR. So what you do is, the first thing you do is hit the cash flow button. What you will then see is CF0 is equal to something. Okay, if you've never used this before, it's 0. If you used it before, it will show you what you last entered. And the first thing you do here is clear all your registers. To do that, you hit second and clear work. So now you should definitely see cash flow is equal to 0. Plug in the first cash flow. So to plug in the first cash flow, you plug in 100 plus minus, and then you must put enter. When you put enter, then you will see an equal to sign. If you don't put that enter over here, that means the cash flow has not been entered into the computer. So you put your cash flow 0 is equal to minus 100. Then you hit the down arrow, you will see cash flow 01. What do you think you'll plug in here? 70. So you plug 70 and then enter. Okay, then so you basically now told the computer that your first cash flow is 70. Then you hit the down arrow and you will see F01 is equal to 1. This means that the frequency of this 70 is 1, which is 1 is the default. You accept it. In subsequent problems, you will see where a given cash flow happens 5 times. Then you will put frequency equal to 5. Rather than plugging in 75 times, you can just specify a frequency of 5, and this is useful, as you will find out. So there F01 is 1, except the default. Just hit down arrow again. Now you will see cash flow 02. What do you put in there? 10. So you put in 10 and enter. Then down arrow, the frequency 1, just accept, hit down arrow again. Cash flow 3 is 90. Enter, down arrow. Okay, so now you have put in all your data. If at the beginning you had cleared all the cash flow registers, that means the cash flow for all subsequent periods is automatically 0, and you can verify by clicking down arrow a few times. Actually, if you click down arrow a couple of times, it will bring you back to CF0 is minus 100. But nevertheless, what we have done so far is we have put in all these cash flows. Then you hit the IRR button and then you hit compute. Okay. Yeah, so magically it tells you that the IRR is equal to 30.5%. And believe me, that's a whole lot easier than solving this cubic equation. So all you've done is plugged in the cash flow and you get 30. Why did I spend all this time explaining this stuff? So that you understand what that 30 means. That 30 means that that's effectively the return you are generating on this project. And while we are at it, just to also show you how easy this calculator is to use, if you go back to your cash flow and now just hit NPV. Okay, just hit NPV. You already plugged in all your cash flows. So you hit NPV and it will show you I is equal to 0. Why is that? Because to calculate NPV, the calculator needs an interest rate. For IRR, does the calculator need an interest rate? No, because that's what's being calculated. So for NPV, you need to plug in an interest rate. Let's use my favorite interest rate, which is 10%. So just plug in 10 and hit enter. And then you hit down arrow. You will see NPV is equal to something. Hit compute and you will see a NPV of 39.5. Okay, so that's really quick. Okay. Now, does it make sense? So when we calculated the NPV, we did a NPV at a discount rate of 10% and these cash flows. Okay. So I'm going to just tie a few things together here. So just store the NPV of 39.5. Let's just mark it down over here and I'll come back to it. Okay, I wanted you to do it while we still have the appropriate numbers in our cash flow. Okay. Now what's the IRR? So we figured out what the IRR is. Now what's the IRR rule? IRR rule again is the rule that allows you to determine whether a project should be done or not. To do a project, the internal rate of return should be greater than the interest rate. Okay, you can sometimes this 10% is called the cost of capital. Sometimes it's called the hurdle rate. All large companies will have some specified hurdle rate. They might call it the hurdle rate, or they might call it a cost of capital. The two interpretations of this: cost of capital means how much does it cost the company to raise money, okay, either through debt or equity. As we'll study in corporate finance, cost of capital is a weighted average of the cost of raising money through debt, equity, and maybe preferred shares. So let's say for a given company, on average, it costs 10% to raise money. Then it makes sense to do only those projects where the return is more than 10%. Okay, so what does the IRR rule then become? The IRR rule then becomes that you do projects where the IRR is greater than cost of capital. Okay, and since you are doing only those projects where IRR is greater than the cost of capital, effectively the cost of capital is a hurdle that you must effectively jump over or must be higher than in order to do a project. And hence the cost of capital is also sometimes referred to as a hurdle rate. So we will only do projects that clear that hurdle. Okay, so that's where the hurdle rate comes from. Okay, so that's simple. If you just have one project, do it if the IRR is greater than cost of capital. Don't do it if IRR is less than cost of capital. If you have two independent projects, so you have two projects that are mutually exclusive. That means you can only do A or B. Okay, and the IRR of A is 20%, the IRR of B is 30%. Which one do you do? Okay, it doesn't take a genius to figure out that you do the one with the higher return. So that's what the IRR is effectively saying. Okay, now just a link between IRR and NPV. Generally speaking, for a given project, if the NPV is positive, then the IRR will be more than the hurdle rate. Okay, and I just want you to understand this well. NPV is positive means you are generating value for shareholders, as we just discussed. If on a given project you are getting a return that's more than your cost, then you are generating value for shareholders. Okay, so there are two ways of looking at the same picture. If you are generating a return that's greater than your cost, clearly that's a good thing. Similarly, if your NPV is positive, that's also a good thing. So these two are practically synonymous. Okay, so that's your IRR and your IRR.
If you found this clip interesting and informative, please visit my website www.arifirfanullah.com. Here you will find a tremendous amount of useful material. Right here in the 2011 CFA video lecture series, you will find the entire level 1 curriculum for free, and most of the material here is still relevant. So this is worth looking at. The 2012 video lecture series covers both level 1 and level 2. These lectures are available for a fee. And finally, down here, financial management at IBA. Here you will find my lectures at IBA for a course on financial management. Plus you'll find lots of useful spreadsheets that can help you with financial modeling. So again, please visit www.arifirfanullah.com. Thank you.